thank you to everyone for coming. I know it's not easy, especially at this time. But didn't I tell you this is going to be a gorgeous event? So I'll just introduce myself because absolutely nobody here knows who I am. But before we begin the program, I just want to explain briefly why I am here. Why I am here, why I am affiliated, and why I've been working with RVW Wealth Management. You know, I went through a vigorous training program and with an excruciatingly difficult examination process to become a licensed financial advisor. Honestly, probably the most strenuous feat I've ever done. Why did I do this? Why? So many of you may know me as Rabbi Shuey Wyne, and I'm so grateful that I've had the opportunity, the privilege, the honor of fulfilling one of my passions, which is to spread God's wisdom to as many people as I possibly can. But I always knew that simultaneously I wanted to engage in another profession as well. But you see, not just merely to make more money, I wanted to be involved in something which would align with the core objective and the primary goal of my other rabbinic work, which ultimately is to provide the most essential, the most important and intimate needs of the people, in the Las Vegas broader community, throughout the country as well, and maybe even internationally. So I became a rabbi, and one thing I discovered very quickly is that, of course, everyone has their own story, everyone has their script, everyone has their own unique set of life circumstances, their own journeys, their own difficulties, their own challenges. But one thing, a similarity I found between each and every person that I would cultivate a relationship with was that the single most common source of stress, source of anxiety, source of pain was people's financial security, or lack thereof, unfortunately. So I made a decision. I wanted to associate myself with a team of experts who dedicate their lives toward providing financial stability, financial safety, toward providing peace of mind, and ultimately to provide the well-deserved privilege that everyone should have to enjoy daily living with family and friends. That's what it's all about. And my friends, I cannot think of a better description which encapsulates what we do at RVW Wealth than that. Thank God, throughout my life, I've had the opportunity to have great mentors, incredible rabbis, very wise leaders. But I am so humbled to be a part of this team. I've yet to see such an extensive and deep combination of wisdom, intelligence, knowledge, experience, coupled with honesty and integrity, and the genuine desire to help every client, but to help every human being, more importantly, that we cross paths with. And today we are graced with the presence of some of our team at our company, RVW Wealth, but this is only a fraction. So just to let you know who's in the room. Firstly, we have Stefan So. Okay, Stefan So is our Chief Investment Officer, and just to let you know, if there's one thing I could say about him, he is a slammed genius. Honestly, he tries to come off as a regular guy. He's a genius. It blows my mind. It blows my mind. We also have our president and founder, Jonathan Gerber. Please take advantage of, I call him Jonathan the Guru Gerber. The Guru is not his real middle name, but it should be, because amongst many other things, this man, this sage, okay, and I repeat, this sage, is a guru like you've never seen before with taxes. The fact that he has assisted over 800 clients in our wealth management firm with tax advantageous approaches toward investing to come up with a low-cost portfolio, tax-efficient portfolio, and many other things you wouldn't even dream of. Jonathan, the Guru Gerber. And lastly, we have, so we also have Mike Chen. Mike Chen is, you want to say hi to him if you have any questions. I think he might be outside right now. Any questions about your portfolio, about our portfolios, he is able to explain in a very clear and concise way anything you may be looking for clarity on. And lastly, Selwyn Gerber. Selwyn Gerber. Selwyn is the founder of it all. Selwyn has built billion-dollar empires, billion with a B. And honestly, I personally have no words to describe the depth of his greatness. One thing I'll say, everyone here is familiar with the concept in Judaism as the Gadol Hador, the greatest advisor in the generation. People who all across the globe seek his advice and want to bask in his experiential wisdom. Ladies and gentlemen, many would consider Selwyn as one of the Gedolei Hador when it comes to investing. And as a primary disciple of Warren Buffett, I call him the wizard. The wizard. He is the Dumbledore, so to speak, if you will, of our modern era. And so without further ado, I just want to call up Selwyn, and if everyone, I would just ask please to stand up for a moment out of respect for truly one of the greatest. Please put your hands together, Selwyn Gerber.
Thank you so much, Shuey, and thank all of you for attending and giving us such a warm welcome here in Las Vegas, where we plan to make a very big move. Shuey, I probably would be best advised now to sit down and let everybody keep the strong impression that you gave them, because as they say, my late father would have been proud of me and my mother would have believed you. It's really a great honor to be here. We are surrounded by a wonderful group of friends, supporters, investors, and our goal today is to kind of dip you in what we call a financial mikveh, a marinade, if you will, that's going to show you what is really the world that we've affiliated with, the world of what's called the science of capital markets. It turns out that while most people think of the stock market as Vegas in Wall Street, the main strip here in Wall Street, in fact, there is a very different way of looking at things. And as Shuey pointed, it's really, there are probably a few dozen people and their disciples who really understand what's called the science of capital markets, evidence-based investing, and a way to view money that is far more scientific, far more factual, far more data-based than the traditional Wall Street model. As Shuey told you, there's one other very big distinction in addition to our basic view of how we design portfolios, and that is the integrity with which we do our work. I only found out about 25 years ago that my favorite broker at a very large Wall Street firm actually was not a fiduciary. He didn't have to put my interests ahead of his own. And in fact, when he told me every summer that he was going on a cruise paid for by his brokerage house, I actually one day realized that it was me that was paying for the cruise through the hidden fees and charges, because the brokerage house is not paying for anybody's cruises. So we set about at that point aligning ourselves with and building out of a very successful CPA firm, which I founded in 1986, and having had so many bad experiences with the so-called traditional Wall Street experience, and we're experts at that, because I actually developed an algorithm which said the more luxurious the offices and the more terrific the presentations are, the less impressive the results would be. And we understood why. Because they follow a different pattern. They follow a pattern of predicting, forecasting, anticipating. We don't live in that world. To be very frank with you, we're a bunch of number crunchers. We don't specialize in golf, opera, classical music. That's not what we do with our clients. We are basically a bunch of number crunchers. We're a firm basically comprised at a management level of CPAs and CFAs. That's a Chartered Financial Analyst. That's the highest qualification you can get in the financial analytical area. And we have a bunch of those and a bunch of CPAs, and we run the firm. And we're data-driven, not by intuition, impulse, kishkas, forecasts, and all the other stuff that Wall Street does. And by the way, as I always say, these forecasters are almost, they're never in doubt, and they're almost always wrong. Almost always wrong. There's no other field of human endeavor where you could be so wrong so often and still be given the podium to tell everybody what you think. And I'm not going to give you many examples, but just one to illustrate. The New York Times, which I don't read, but I do know about, has an economist by the name of Paul Krugman. And Paul Krugman is very famous and obviously has a big column in the New York Times every week. At the time that Trump was being elected, at the very moment of the election, where it looked like he was actually going to win the presidency, he was asked on the cable news that I was watching at the time, what do you think would happen if Trump actually won this election? What do you think would happen to the stock market? And here are his exact words: "It will enter into a prolonged decline." And they asked him, how long do you think it will take for the market to recover from that decline? And he said, it probably will last indefinitely. Now, this is a man who still has his column every week, and everyone wants his opinion. In any other field, if you were that wrong, just imagine if a weather forecaster did that in Las Vegas and said the weather tomorrow is going to be ice, sleet, snow, hurricanes, minus 30 degrees at the low. How long do you think he'd be on the television station? What, one show, maybe? Probably half a show, they'd kick him off. So we're not in that world at all. We're actually in the world of current data. And everything we do is a response to analysis of financial statements. Shuey pointed out earlier that we consider ourselves disciples of Warren Buffett. We are. We don't think of ourselves as Gudole Hador. We actually think of ourselves as pygmies sitting on the shoulders of giants. And our job really is to decide whose shoulders we're going to sit on. And that's where we come together with Dimensional, and you're going to hear from Apollo in a very short while. But that's where the wisdom lies. Dimensional is a fund that we have been associated with from our very beginning. It's considered to be the Rolls-Royce, the best fund, although you probably haven't heard about it because until recently they kind of kept themselves under the wraps. I'm not really sure why they did that, but they did that remarkably successfully. I see Apollo's chuckling. We're all chuckling. Why did you not come out earlier? They were kind of in the closet for a long time, providing only indirect marketing through people like us, but they never actually made themselves known on Wall Street for the public to access. But that's where the wisdom resides. And they're not the only ones. There are a number of people in that category, but they certainly are the first and the most important in that field. And the people who inform and direct the dimensional approach to wealth management are the Nobel Prize winners. That's where the brains are. People who understand that you look beyond the day-to-day headlines, and to put it into a sports comparison, which I love, we focused on what happens on the sports field, not on the scoreboard. Now, most people are just the opposite. They're looking at the scoreboard all the time. But Apollo and the really smart people at Dimensional, and I'm not using that word flippantly, that's where if you look at their board of advisors, almost everyone there's a respected professor or Nobel Prize winner or both. That's really where the brains are. And what they've done as a result of tremendous research into what works and what doesn't over time, not all the time, but over time, is to understand how markets really work and how selection and then patience and understanding the workings of the market system itself help you to optimize returns over the long term. And they have a fantastic track record. And they do it not because they picked it right. They didn't get the right number on the roulette table. They did it because they have a systematic, logical, data-based approach to designing portfolios that work for the long run. So I wanted to, first of all, thank you for coming. I want to thank Shuey for the great things he said about us and our team. And I want you to know that team has been hand-picked diamonds. And I'm very honored to surround myself with those people. As I said, it comes out of a whole approach, which is a very different approach. Integrity at the core, supported by data, research, and incredible service to our clients, because we take a holistic approach to their financial well-being. And we don't have minimums, which is something we decided right at the beginning. By the way, we do not have minimums. The reason for that, crudely put, is every happy client is a walking billboard. And what we're looking for is to have a few hundred walking billboards here in Las Vegas. That's our goal. And with that, I'm going to introduce Apollo to you. He really understands the world that I'm alluding to and the world with which we affiliate. Apollo, it's an honor to have you and to be affiliated with Dimensional. It's really, literally, and you will find out, a very different approach from the traditional experience that many of you have had with the brokerage community. Thank you so much and welcome.
Thank you so much. And it is an honor and an absolute pleasure to be here. I can't tell you how excited I was to come here. First of all, I live in Los Angeles, and I have not gotten out much. I don't know about you folks here, but LA has been pretty locked down. I mean, I had to go find my grown-up pants and shoes. Thank you so much, but I've known you for a long time, and I think within Dimensional, we all recognize what you've built here. And what I want to talk about is not a product pitch. I'm not here to blow your minds about how good these funds are and why we should all invest and get rich in these funds. Rather, what I want to do is take you on a bit of a journey. Because I see a lot of folks here have traditions, and there's no doubt that traditions are important. I'm not talking absolutely crucial in everybody's life. At the same time, some things change. There's an evolution in absolutely everything in our life. And that evolution is quite important. Because what used to be state-of-the-art at some point, like putting a mic down, what used to be state-of-the-art changes. I live in West LA, and when my kid came home for Christmas from college, we walked down the street, and he made a remark. He's like, "Dad, when I was a kid, 20 years ago, we used to walk down, and there was a Blockbuster Video on the corner of Westwood and Olympic. I don't know how many of you remember, but there used to be the store Blockbuster Video. And 20 years ago, it was perfectly fine to go rent a VCR tape, pop it in the machine, take it back, pay the late fees, get another one. That was fine 20 years ago. But Blockbuster Video in the age of Netflix and Disney Plus, it doesn't make as much sense. So the question is, how has the world of investing changed, and what does it mean to you? How do you stay ahead of the game, and how do you use data and evidence, not opinion, to inform those decisions? So that's kind of what it is. It's about the evolution and what it is today, state of the art, when you look at data and evidence, not opinion. And I'll start with just a broad, comment that someone made, which is, I think it's a phenomenal concept. Stock market is not a gambling casino. It is not. And why is that? Because stock market is one of the most fundamental things that we have in this country and around the world. Because stock market allows you and I and everybody in this room to buy ownership in companies. You can be an owner into a company without actively participating in the running of the business. That is what the stock market gives you. It gives all of us a stake in capitalism. So I think it's an important premise, and when you buy ownership into companies, that's what you get in the market. And the big question then has become, what companies do you buy? How do you go about choosing what companies to buy ownership in? And the main premise of buying a company, one of the most important determinants that all of us have to examine is what's going on with the company. And in that respect, information becomes crucial. Stock market and investing is about information. And I would argue the biggest change that has happened in the market is information. It all has to do with information. And a little trivia. I'm not sure anybody might know this, but anybody knows the very first stock that traded on the modern basis, the way we trade stocks today? What was the very first modern stock? The reason I kind of like, my son asked me, but also there was a movie, Ocean's 13, and they were supposed to steal the very first stock certificate. Anybody knows what it was? The Dutch East India Company, 1602, over 400 years ago. People pulled money together, anybody got ownership who wanted to buy ownership, and they will get a fraction of the profits that the company makes. That's exactly how it works today. And when you want to trade the share of ownership, you don't trade it with the company. You have to find some other member in society who wants to take that piece of ownership, and you have to agree at what price to exchange that ownership. That's how stock market works. So back in those days, the same as today, what was really important is to have information. If you knew that a ship got lost or pirates destroyed it, whatever the case might have been, that was information that was valuable to you. How long do you think it took for that information to get to markets? Probably weeks, right? The biggest change has been how fast information gets to people, what type of information is available, and how it's processed by folks. And the market went from taking weeks to get information to days, to hours. I would argue that about 100 years ago was in the minutes. About 30, 40 years ago was in the seconds. How long do you think it takes today for information to get to market participants? It's almost instantaneous. So the speed at which investors get information has dramatically changed. The second thing that's changed is the availability of information. And just to illustrate with an example, about 15 years ago, a company in the Bay Area launched an army of mini satellites into space. And the sole mission of the satellites was to snap pictures of Walmart parking lots, and the software would count the number of cars parked in the parking lot so they can see if the sales are up from one year to another. That's the level of information that all investors have. So the level of information is dramatically greater than it's ever been. And the third change when it comes to information is that it is not competitive right now in the market. There are so many professionally managed funds that in fact today in the US there are more professionally managed mutual funds than actual stocks trading on the market. It is crazy competitive. Crazy competitive. So the question that becomes, that idea of analyzing individual companies and trying to get ahead by analyzing those companies, that particular way of approaching investing, in my opinion, is no longer state of the art. Because it's incredibly hard to believe that anybody today in society can consistently have a competitive edge when they trade, to get better information, to get it faster, or to be able to process it in a way that nobody else did. So the first thing that I would say is that if you look at the market, and let's just say that this particular square represents the entire stock market, the conventional way, the more traditional Wall Street way, was to look at companies and cherry pick what you thought were the best stocks. Leave out everything else, which is intuitively appealing. And that is basically what the state of the art for many, many years was. Tell me what stocks to buy, I'll put money into those stocks, I'll leave out everything else, and I'll make a lot of money. Have any of you thought about that? Or maybe done it yourself, or had somebody do it for you? I did it. I mean, at some point I did it myself. Nothing wrong with that, because that was the way to think about investing maybe 25, 30 years ago. The problem is that when you start looking at data, what you find is that the data is telling a different story. If you look at these managers who are the MBAs, the PhDs, the Stanford, the Harvards, and you ask the question, how many of these managers who pick stocks actually outperform? What do you think is the case? Well, when you look at the data, what you see is that when you look at these folks over 10 years, these are managers who have picked stocks. Over 10 years, there are about 3,000, almost 3,100 different funds that are doing exactly the same thing. They're buying and selling these stocks in their investments. And when you look at their 10-year track record, what you see is that remarkably, about 37% of them, so more than a third, actually disappear. They don't even make it as a business. And out of those who survive, only about 23, less than a quarter, outperform. So if you're an investor and you're saying, I want to pick some of these managers who are so smart and they're going to pick stocks, your chances are 3 in 4 that you're going to pick a loser. And if you give them more time, if you go to 15 years, what you see is that it gets even worse. More funds disappear and even fewer outperform. And then when you look at 20 years, it gets even worse. So the main gist of the story is that in the world of how investing changed, this idea that picking stocks as being a winning proposition is no longer the case. It's no longer the case. It's not worth paying a lot of money for these managers to underperform. Your odds are totally against you. So if you're not going to do this, well, what else is there to do? And this is where I think the idea of academic research came along. And when academics looked at individual stocks, what they found is that, really, this idea of trying to understand and predict an individual stock is not really productive. It's too competitive. And information goes in too quickly for anybody to take advantage. But that doesn't mean that all hope is lost. What academics and basically Dimensional pioneered is a different type of research. And in this kind of research that is not always common knowledge, the main point here, the main kind of concept behind it is that instead of love or hating any one stock, you absolutely want to consider these stocks. But instead of forming an expectation about the stocks themselves, each individual stocks, what you ought to do is understand their behavior as part of a larger basket, a larger group of stocks. So it's no longer about individual stock research, but much larger baskets of stocks. That's the main difference. That's what started state of the art today. And for the longest time, I was trying to explain this to my mother-in-law, and it didn't work out very well until years ago when I went to Florida, and I went for a little swim in the ocean, and they do have warm water there, so I was swimming, and I had my goggles on, and as I looked down, there was a school of fish swimming right underneath me. And it wasn't a very colorful Finding Nemo type, but it's still pretty fun. And as you look, you see that every fish was moving so randomly, up and down, left, right, sideways. No way you can predict how each individual fish should move. But once I swam a little bit longer, I started to capture and understand the behavior of the entire school of fish with a lot more precision. And that's when it hit me. This is about fishing by the net. This is about understanding the behavior of an entire school of fish. And that's what we're saying. This academic research, this more data-driven, is not about individual stocks, but much larger groups of stocks. And that's what computers and data have allowed investors, professional investors, to do, to understand the characteristics of the different types of stocks. Not all fish are the same, not all stocks are the same. So then how do you differentiate among them? And the first differentiator that came along was in the late 70s and early 80s. And when academics looked at this issue, what they found is sector, which is quite often put out there, technology, pharmaceutical, transportation, that is not the way to go. They looked at this, they said that's not a way to go. But instead, the very first way of delineating stocks in the market, and which is still with us today, it has to do with size. It has to do with the size of a company. And you have some large companies out there. You have Google, Microsoft, McDonald's, Coca-Cola. These are large companies, and quite often they're associated with the Dow Jones or, a broader measure, the S&P 500, which are the largest 500 companies in the U.S. market. And they're perfectly fine. You hear about them all the time. But it turns out there are about 2,000 other companies in the U.S. which are not part of the S&P. They're called small caps or small company stocks. And these are also part of the market. And, have you heard of McDonald's, of course, of Shake Shack? Any of you familiar with Shake Shack? That is a burger joint that trades on a stock exchange in the U.S. You can go buy ownership in that. And you have a choice. You can either buy McDonald's or Shake Shack, right? Now, if I were to ask you, which one of these companies has a longer track record, is a more mature, well-established company? McDonald's. But which one has a bigger potential to grow and perhaps double in size? Shake Shack. So small companies and large companies, they are different. And when you look at data, what you see is exactly that. There's a difference between large and small. So there's a book that we have there called the Matrix book, and it's a phenomenal book of numbers, but it does have a very easy to understand way to look at this. How much would a dollar have grown since we have data? It turns out my dad is born in 1926. He's 95, and that book starts in 1926. What if my grandparents had put $1, one single dollar, not 10 or 100, into the S&P 500? What do you think that dollar would have grown to by the end of 2020? What's a guess? $1. $30? Do I hear 40? Well, actually, I think it's on page 15 or 17 on the upper right-hand side. It's a growth of $1 going back to 1920s. I think it's page 17, and Shuey has the number. But I think it's more than 30.
10,937.
Let's say 10,000 bucks. That's a big growth if you put your money in the S&P. That you leave it alone, you don't touch it. It doesn't matter, the wars, the repressions, all good times, bad times, you leave the money in there. $1 in my dad's lifetime grows to 10,000. Now, if you had taken the same dollar over the same time period and put it into small companies, do you think you would have had more or less? More. How much more do you think? 3,000 more? I think it's on page 39 on the upper right hand side is the growth of $1 in the small company group of stocks.
An incredible $36,153.
$36,000. More than 3 times as much. So why this is so important is as an investor, all of you have a choice. You can put your money into what you see on the news, the S&P, but if you wanted to do better, what else can you do if you're not going to pick stocks? You tell me. You can look at some small company stocks, and over the long run, they have delivered better returns, a higher growth on the assets. And if you now ask the question, what about all the large companies and all the small companies? Are they the same? The answer is no. You can now further distinguish based on the price and how expensive it is to buy a company relative to, let's say, their book value, which is assets after liabilities are paid, or earnings or cash flows, anything that you can measure from an accounting perspective. And the low price stocks are called value, and over the long run, they have outperformed the more expensive stock of growth. So if you know that value beats growth and small outperforms large over the long run, what's the one part of the market that ought to give investors the biggest bang for the buck over the long run? Small cap and value. So if you now look, I think it's on page 41, the next page over, it's exactly the same dollar, same time period, but now invested in this subset of small value. What do you guys think the growth would be instead of 36? Would it be probably a little more, right? Well, should we, with a little drum roll? 41, I think it's on page 41 on the upper right-hand side.
Are you ready for this?
Are you ready for this? $92,668.
Over 92,000 bucks. So this is why this system, this academic approach is actually very relevant to all of you as investors. Because what it allows you to do is be very purposeful. You can say, I can buy the S&P, and that's exactly what I get on the news. That's what's going to be in my portfolio. But if you want to have a higher expected return on your money, all you do is you purposefully emphasize small company stocks and value stocks. So that to me is why this is so important to look at data and evidence, because what you're doing now is you can be very purposeful in the way that you invest money. So that's what we had. And at some point, there was another question. Are these the only 2 things? And there's one more thing that matters. And I'll come back to it in a second. But if you saw this, if you just simply looked at this picture right now, what would be the first thought that you would have? I don't know if you could. Why doesn't everybody do it? Exactly right. What's another one? Why not put all the money in small value? Why, play around with the S&P when I can make so much more? There are all these questions. What's the risk associated with this? Because that's the idea. It's like, I can make more money. What's the catch? You should always ask, what's the catch? And there's a very big catch in all this, very big catch. And that's one of the reasons that it is not done by individual investors. This system of investing, it is not about certainty or guarantees. It is all about understanding statistics and probabilities. And for this system to work, you do need to have a financial advisor. Without a doubt, you need to have a financial advisor. Why? Because when I'm showing you these numbers, and you saw this, and you go meet with a team a quarter from now, and perhaps value has not beaten growth, and growth has beaten value, how would you feel then? Bummed out, right? It's like, okay, I'll give you another quarter. You come back a quarter later, and it still hasn't happened. How would you feel then? Maybe a little disappointed. And so I'll give you a whole year, and it hasn't happened. How would you feel then? pissed. Maybe that bald guy didn't know what he was talking after. But the thing is that this is all about statistics and odds. When you look at this over 1 year, what you see is that about 60% of the time, 59% of the time, value outperforms growth. But what's the flip side of that coin? 4 in 10 years is not going to be there. You will be disappointed. And you'll be pissed. And you'll be like, well, this is not working because, look, growth has beaten value. And you say, I'll give you 5 years. Okay, I'll come back in 5 years. And if you look at 5 years now, what you see is that your odds improve. It goes now to 72%. But even after 5 years, 28% of the time, about a quarter, you will be disappointed. How will you feel then? Will you be able to stick with the program? That's the question. And that's why an advisor is so important. But I go back to this. We're in Vegas. It's all about odds. If you saw these odds, which part of the market would you like to emphasize? Which table would you like to play at? The growth or the value? You could be disappointed 28% of the time, but your odds are better. Another way to think about this is, listen, we all try to work out and eat healthier, but it doesn't guarantee us a longer lasting, healthier life. It just improves the odds. That's why looking at odds is so important. And that's why, because 28%, even after 5 years, it will not be there, it's important to balance these trade-offs. You can't put all the money in small value unless you're really ready to look very different than what you see on the news. And even if you go to 10 years, after 10 years, you do see that odds improve, but even after 10 years, it's not 100%. So to me, that is really the key to this evolution, is understanding the dynamics of different asset classes, and then once you understand them, to make sure that you have an advisor to combine them all and make sure you stay disciplined. Now, I mentioned that beyond these two characteristics, the size of the company and the value growth distinction, over the past few years, there has been one more that it's worth mentioning, which is how profitable is a company, which is called profitability. So you can add this as well, and it turns out that companies that are profitable, they tend to continue to stay profitable. Companies that are unprofitable, they tend to continue to stay unprofitable, so you have to adjust for that as well. But these are, if you ask me, these are the three main dimensions of the market. If you're an investor, these are the three things that you ought to pay attention to. Not sectors, not things. These are the three things to consider. And also the risk associated more with behavior than anything else. That's the first thing that emerged. The second thing was that a realization that as big as the U.S. is, as a stock market, what an investor can do is mitigate the market movements in the U.S. by not just buying locally, but looking at the global opportunity set. And if you redraw a world map, and instead of plotting the value, the landmass, you were to plot the value of all companies that you can buy and sell in different countries, this is what the world looks like. The U.S., when you add up the 3,000-4,000 stocks that we have, Apple, Google, Microsoft, all these companies that we have, amounts to about 57% of the value of all companies that you can buy and sell. Which means that roughly half, or less than half, is abroad. And this is so important because quite often you hear folks, well, I'm okay with the U.S. because we sell a lot abroad. But the reality is that the other scenario also applies. The other companies sell to us as well. So when you think that, okay, I can just buy in the U.S., that's fine. And it's almost like you're saying I can buy, maybe like a Ford and GM and a Tesla, and I have U.S. companies. That's fine. But look down the street. Are these the only cars that you see? Are they? Of course not. I mean, you look down the street and you're going to find some Beamers, you're going to have some Mercedes. You look down the street and you're going to find even more, even American cars like Jeeps and Chryslers. They're owned by a company trading in Italy, Stellantis. You go down the road and you have all the big Japanese car companies. They sell to us. You have even brands like Jaguar and Land Rover owned by an Indian company trading in India. You have even Volvo was owned by a Chinese company, and you have certainly the Korean companies. So what we're suggesting is that it's not just about us selling abroad, but what's being sold to us that makes a difference as well. So to me, that's a really important consideration here, is that you have to look at a global marketplace, and when you do, what you find is that the U.S. is not consistently the best performing country, is not consistently the worst performing country, but you do need to have diversification abroad. So that's the next thing that is important to consider. All right, so far I've been covering a lot about stocks. And when you look at it, you say, great, stocks, but stocks can be risky. I mean, there's a situation right now that over the past few weeks, as you've seen, the market has tanked tremendously and it's not looking that good for the stock market. And the question is, how do I protect myself? Ultimately, I understand. I can buy some small companies, I can buy some international, but how do I protect myself against the market downturn? And there are two very distinct ways. Particularly now you have this geopolitical risk that's going to make headlines for some time now. And people are going to wonder, well, how do I somehow protect my money? And the reality is that there is no silver bullet to say, get out of the market today, because you also need to know when to get back in the market. And that's the hardest thing to do, to know when to get out and when to get in. But what academic research has found is that there are actually two other ways to mitigate against market downturns. First, we talked about having stocks abroad, but the second is the most powerful one. When you buy stocks, you buy ownership in companies. But that ownership basically comes with fluctuating profits. The world moves around, profits fluctuate. There's something else that you can do with your money, which is lending. You can lend money to corporations and governments, and there's a contract that specifies an interest rate that you will get, for how long you get that interest rate, and at the back end you get your money back. You can get into this deal with the U.S. government, with the German government, with anybody you want. And those are called bonds. How many of you are familiar with bonds? Bonds are incredibly important, because what tends to happen is when the stock market drops, bonds do not move in lockstep. They don't. When the stock market drops, bonds tend to hold their value quite well. In the first quarter of 2020, when we had the pandemic raging for the first time in the world, the stock market dropped significantly. The bonds actually went up. Over the past 20 years, in every single instance when the market dropped significantly, in every single instance over the past 20 years, when stock market dropped significantly, the bonds actually went up in value. And from a risk management perspective, having bonds in your portfolio might be a really good way to mitigate whatever happens in the world. So a balance between stocks and bonds, one of the most important decisions that you can make with your money. So kind of summarizing all, because I don't want to overstay my welcome here, but summarizing everything that we talked about so far. The modern way of thinking about investing is not about stocks and loving or hating any one company, but asset classes, diversifying abroad, and then when that's not enough, a way to mitigate the market volatility, particularly in days like this, is to hold a portion of your money in bonds. Now, what is the right mix? It depends on your financial plan, which comes back to what you heard earlier. It's not about the product, it's about the plan. Once you have a plan, you can decide how much you want to put in stocks versus bonds. And there's no cookie-cutter answer. It really depends on your plan. So, yes, thank you for asking.
Wonderful presentation, by the way.
Thanks.
So, historically, is that unwise to invest heavily in the bond market? Enjoying your talk very much.
Thanks.
Historically, hasn't it been very unwise to invest in bonds when rates are at historic lows? I bought stocks in the 80s when interest rates were 14% and sold them 5 years later for a significant profit when interest rates had dropped. So is the converse true?
So it's a very good question. So if you have interest rates that are very low, is it unwise to basically have bonds? Is that something that we shouldn't be doing? And the answer is no, because the role of bonds, it's quite often people think that the role of bonds is to give you an income. I want to make some money in bonds. The reality is that the role of bonds is not necessarily to make you money. The role of bonds is more like, do you go sailing? But you know that we put the sail up on a boat, the boat goes fast, right? That's what the stocks are supposed to do. They're supposed to make it go fast. But when they go fast, it also fluctuates a lot. So in that respect, if you look at the stock market, that's what you see is that over the long run, you would have made 9-10% per year on average, with a lot of fluctuation. But you would have had that amazing growth of $10,000 in your portfolio. The point that I'm making now, if you look at bonds, the reason you want to have bonds is not because you make a lot of money. It's because bonds typically protect you. If you gave the government money, the U.S. government, for 30 days, after 30 days you get your money back plus interest. That's called a 30-day Treasury bill. Over the long run, there was not even a single negative year when you would have lost money. Not a single negative year when you lost money. In fact, there was very little fluctuation in value, and you would have earned a little bit over inflation. So if you want to be protected, there's nothing else that replaces bonds. Even though the interest rates are low, interest rates might be going up, there's nothing right now that does as good of a job. But just to kind of give a perspective how different bonds are, if you grow the same dollar at 3-4% in these Treasury bills versus a 9-10, what do you think the 10,000 becomes? Any guesses? Instead of 10,000, what would it be at 3-4%?
Because we don't want people to walk out with
I'm sorry? 5,000? Shuey, I think it's on page 61. It's the growth of a dollar in over the same time period. So same dollar, same time period, but now invested in the very safe Treasury bills when you never lose money. What's the dollar growth? 61, I think it's Treasury bills.
Is this accurate? $22?
$22. It's not missing any zeros. That's what bonds do. The bonds are there to be the ballast. They're the ballast to slow you down but give you stability. So the bonds, even in raising interest rates, they're there to give you some stability. And by the way, I have looked at 1978, 1979, 1980. 3 years when we had really high raises in interest rates. Do you guys remember the late 70s and early 80s? Interest rate went up tremendously. The Fed, over 3 years, raised interest rates by 12%. How many of those 3 years do you think the stock market lost money? How many of those 3 years do you think the U.S. government bonds dropped in value in returns? None. None of those years, even though interest rates go up. So it's so to me like the idea that because interest rates are going up or they're low, bonds don't have a role, that's not supported by data. And look at this. If you look at like I mentioned the first quarter in 2020, stock market dropped for the first 3 months by almost 20%. Bonds were up. Look at the other years when the market dropped significantly, bonds are up. So in that respect, bonds still have a role, even if interest rates are actually low. So that to me is a very important point. And just to see how important this is. This is the Matrix book that Shuey has. And there's in the Matrix book, there are a set of model portfolios. And these model portfolios basically blend stocks and bonds. And you look at stocks and bonds, and you feel free to look at the book. This is coming exactly from that book. And here's what you see. When you invest in a portfolio that is made at 100% out of bonds, 100% out of bonds, what you see is that the worst 12 months that you would have had, I don't know if it's too small to see, right? It's probably too small to see. But let me give you the gist of it. The worst 12 months in all bonds portfolio, you would have lost 1.3%. And the money since 85 would have went up 6-fold in 100% bonds. Very little drop in value, went up 6-fold. Every time you add more stocks, the worst case, the worst drop increases. It goes from almost break even to -10, -20, -30, -40, but the growth of a dollar increases as well. So it's that the relationship between stocks and bonds is hugely important. Yes?
Yeah.
So the question is,
Apollo, sorry. In the interest of time, I know if you want to answer that one other question, and then we'll start closing.
okay, so the last question, very quickly, how does age play into this? Age doesn't play as much as income. When you are younger and you have a steady job, then you can take more risk with the stocks because your daily living is covered by your paychecks. So if you have a steady job, when you're younger, you can put more money to stocks. As you get older, what happens is that if you don't have a pension, then you no longer have that cushion of stability coming from your paycheck. So if you don't have a pension, then you have to replace that stability of a paycheck with some more bonds. So as you get older, you might want to put more into bonds, but not even that, depending on the plan that you have, you might not want to go overboard with too much in bonds because you don't grow as much. But if you have a pension, it's at that point, that pension is almost like a paycheck. So it really depends on your circumstances. If you are a business owner, how many of you are business owners here? If you're a business owner, then a large part of your assets is in the business, which is equity, which is like the stock market. So if that's the case, then even in the earlier years, you might want to put more in bonds. So it's a more complicated question that doesn't have as much to do with age, but rather the sources of income. And what are the sources do you have, and how everything kind of fits together. Well, I'll come and we'll talk right after.
Thank you for all the wonderful questions. We'll be around after the event ends to answer any more questions you may have. And Apollo, as always, thank you for all of the data. As you could see with Apollo, he's very evidence-driven, really talking about the science of the capital markets. And one area I think you touched that's really important is the area of profitability. So without getting into it too much, one of the things that we're seeing a lot now is we have clients that say, okay, I'm holding this other portfolio. Can you analyze it's just dropping quite a bit? And when we look at the portfolio, it's the likes of Netflix, Facebook, Tesla, some of these type of companies. And when you're really getting down to it, and as you know, we have a lot of CPAs that are numbers driven here, the profits just aren't there. So when you're seeing certain data, and it's a lot of these companies that have negative profits, meaning they're actually losing money, for quite some time now it was all about what's the user growth. So you may have heard that term quite a bit, but now the actual fundamentals matter.
Yep.
So I'm glad you touched upon that. And one other thing is you discussed S&P 500 quite a bit, which is really the 500 large companies in the U.S. And one thing I think it's also important to talk about is the diversification aspect of it. Has any of you heard about the lost decade? So that's a period from 2000 to 2009 where actually the only major grouping of companies that lost money was S&P 500. From 2000, if you invested $100, you're at $91 at the end of 2009. So that's where some of our core investment philosophy comes in, is because if you're talking about the same companies that track companies, so S&P 400, which is the mid-sized companies, was up 85% during the same time span. So that's some of the evidence-based approach that we take to portfolio construction. And based on a lot of the wonderful questions that we had actually prior to you coming here, one theme always came up, which is inflation. So I want to ask just one question for you is, as we're seeing different data points around inflation, whether it's CPI and so forth, it's been persistent for several months now. What is the best way to protect yourself from an investment perspective when there's a high inflation?
Yeah, so inflation is on the news, and first of all, there are different scenarios about what might come next. There's a line of thought that maybe this is going to be persistent for a while, but there's a very large school of thought saying, no, there's a narrative and a scenario where it's temporary, and then once you get back to normal, things are going to come back down to more what we used to know. But right now, by the way, the expectation, if you look at the markets and the way that investors are putting money to work, what you see is that the expectation of inflation over the next 3 years or 5 years is about 3%, less than 3%, which is less than the long-term historical average. So, again, we don't know what's going to happen, but the current one is about 3%. The thing is that if you want to protect yourself, there are two ways in which you can do it. The first way is what's called hedging. And hedging means that every single day you are protected against inflation. And the way it works is there are certain types of investments The most well-known is called the Treasury inflation-protected securities. These are a type of bonds issued by the government that adjust in value with inflation. So if inflation goes up, so does their value. So you're always protected, and that's why it's called hedging. There are some funds that have another type of protection called a swap. In other words, if you want to hedge and every single day you want to be protected against inflation, you can do that. There are solutions right now for that. But there's a secondary way to think about it, which I don't really care about every day. I just want to make sure that I outpace inflation. I stay ahead of inflation for my long-term goals. And we looked at this, and this is what we found. When you look at the market, when you look at the stock market, in years when inflation runs higher than average, the stock market is a pretty good way to stay ahead of inflation. When we ran the data, what we found is that the stock market gives investors probably about 5% more over inflation over the long run. So the stock market is a pretty good place to actually hedge and outpace, not hedge, but outpace inflation. So it just depends on what you're trying to do. If you want to hedge, boy, you know, Stephen, you know about all these investments. You can do it right now. But if you are looking more to outpace for your financial plan, then having some stocks, having some bonds, diversify, that tends to be a good way to stay ahead of it.
Great answer, thank you. And in the interest of everyone's time, again, all the RVW team members will be around after the meeting, and now I'll hand it over to Jonathan Gerber to close. Thank you.
Thanks.
Thank you, Apollo. Thank you, Apollo. It's a great honor to be associated with you and your team, Apollo, DFA. I think your group really exemplifies the science of capital markets on the continuum of the spectrum. On the one end, where advisors use gut or kish gut to make decisions, and versus science and data, DFA, Dimensional Fund Advisors, is definitely on the side of science. And that's really where we root our advice, our guidance, our principles in the science of capital markets. In closing, I just want to emphasize two distinctions between our firm and many others out there. The first is the fiduciary role we play relative to you. My father mentioned it at the beginning, but I just want to reemphasize it. If when you speak to your advisor next and you ask them the following question, if there's a pause, a stutter, a hesitation, you'll know the answer. The question to ask is, are you always a pure fiduciary? Ask that question and see what the answer is. Are you always a pure fiduciary? Do you always have my interests in mind? Because overwhelmingly in this country, advisors don't have that standard of care, of duty, of loyalty to their clients. And it's a huge differentiator between our practice, our morals, our ethics, and our relationship with each and every client as compared to most of our clients' prior advisors and relationships. And the second is, what's your training? You know, Shuey surrounded himself by CPAs, CFAs, CFPs. We understand this stuff. Not only do we understand it in the context of your portfolio, but we understand it in the context of you, of your family, of the intergenerational wealth transfer, of retirement planning in a way that's deep. And I think those are really two very important questions when choosing who to guide you, who to see you through the transition from accumulation and work ultimately to retirement and comfort. And with that, I'll just say thank you very, very much for being here. And thank you, Shuey, for putting this together. Really, thank you.